Hello investors and welcome to another video. इस वीडियो में we are going to analyze a company with a market capitalization of around 4800 crores. और ये कंपनी जो है बहुत ही ज़्यादा इंटरेस्टिंग है. It has been in existence for over 27 years now. It has a very unique business model on all the fronts. अगर आप liability side पे देखें, the way they borrow money, right? They do something very unique. On the asset side, they do something extremely unique. They have a very good management. But इस सब के बावजूद if you look at it from the IPO, October 2017 में इसका IPO आया था, तब से लेकर आज तक the stock price is given only 6%. Right? So that's a very interesting dynamic to understand what is happening within the business, to understand what are the future growth prospects, right? We're going to do a business analysis और इस analysis को हम 5-6 different parts में break down करेंगे. सबसे पहले we look at the quick history. So we want to understand the context in which or the journey through which the business has been moving and where we are at today so we can understand where we're going. Secondly, we'll break down the business model into 3 different parts. सबसे पहले the liability side, borrowing money, right? जहाँ पे we'll understand something very unique. Then we'll discuss the asset side where they give out loans. We'll understand that, something very unique happening there. Thirdly, we'll discuss the profitability, right? Now, this is an NBFC which is profitable. And lastly, we'll discuss growth triggers and finally risks involved. Right now, before we move ahead, go on with the business analysis, I have a very simple request. As always, if you like anything about this video, please consider hitting the like button, and also please, most importantly, consider subscribing, because these videos take a lot of effort, a lot of time, and when people subscribe, it means a lot for me, for our team, for this channel. Right. So having said that, let's move ahead and start the business analysis. So when I started researching this business, one of the first things I wanted to know is that how they got started. And in my whatever little experience I've been reading and analyzing businesses, what I found is some of the most successful businesses were born from a very simple insight that they had during the time, and they acted on it, and it became an Infosys, for example, or a Mass Financial or whatever. So I wanted to understand that what was the story right at the beginning, and I couldn't really find anything. मैंने काफ़ी research, जितना whatever I could read online through my other sources, and I couldn't really find an answer. And so I decided, what else? Let me just write an email to the co-founder, Mr. Kamlesh Gandhi. And he's the chairman and MD, I believe, right now as well of the company. So I said, okay, let's write to him and ask, what's the story? And I wasn't really expecting a reply. I just कि चलो करते हैं. But surprisingly, I got an email back from him, and in 2-3 sentences, he explained it quite beautifully. And the email exchange should be in front of your screen right now. Now, I have blurred out most of the contents of his reply, not because it's a secret or anything I want to kind of withhold from you. It's just that out of respect for the person, because I don't have his permission to kind of share this on a at least share his email on a personal on a public platform. But basically, he said, what I learned from the email was that 1988 is when they started. And when they started, they actually were not financing at all. They were actually selling consumer durables, right? And they were selling consumer durables 1988 में क्या ही होते होंगे? I mean, I doubt there were fridges, but maybe TV was there, coolers, fans, maybe press, electric press, basic consumer goods. And they were selling this to large institutions at the time, large companies, उनके employees को. And obviously what they realized was that if we give these people financial assistance, the whole concept or the idea behind, buying something on EMIs, that we would be able to sell more of our goods. And so they actually started selling consumer durables and realized the business of financing is actually much better. And they, kind of transitioned into that. It took them 7 years to reach 2 crores of capital. They then used that 2 crores of capital to form the Mass Financial in 1995. And since then, over the last 25-27 years of Mass Financial's existence, it has been one of the most consistently growing stories in corporate India, and it has grown roughly at around 40%. And it's a phenomenal growth story. Obviously that doesn't mean कि 40% अभी तक है तो आगे भी चलता रहेगा. Of course, I mean, the things change as the size becomes larger. Maybe not 40, maybe 20-25% growth is what the management is guiding for. Of course, we should take that as with a pinch of salt. We're not simply going to believe what the management is saying, but I'm just giving you a little bit of context, a quick history. And so after 27 years, 2017 mein the company listed at 660 rupees a share, and over the last 5 years it has not done well as far as the price return is concerned. There are two major reasons for that. Pehla tha ki jab IPO aaya, it was already so expensive, and I think this is a lesson for investors, because IPO aata hi tabhi hai when company or when things can be overpriced. So it was already so expensive and everybody wanted to invest in it that from that kind of price it was very hard to make a return. And then obviously COVID happened 2019 mein, NBFC liquidity happened, COVID happened. So last 3 years the profit has not really increased at a pace that we would like. So that's basically a little bit of context. And finally, one of the most fascinating aspects before we actually move into the business model and look at the liability side of things, one of the most fascinating thing is the way these guys raise money, because by nature, financial institutions have to dilute their equity to get growth capital, and we'll understand why they have to do it. But as a consequence of that, the promoter shareholding in the company is 73.7%. Now, this is, I actually don't know of any other promoter in any other NBFC. Banks mein to for sure is not allowed only, but even in NBFCs I have no idea. I don't know, maybe there are, but they're so rare that you'll have that shareholding. And so this interesting model of being able to internally get the money to continue growing also, right? That is what is going to be one of the key highlights of the next section where we discuss the liabilities part. The way Mass Financial has handled the liabilities side of its business is truly quite fascinating, and they call this a self-propelling model. And obviously for a finance business, for a lending business, money is a raw material, and so a big part of the entire cycle or the entire business cycle is that obviously you raise money, then you lend money, and between the raising and the lending of money, you obviously try to make money, and hopefully you are making money, right? So liabilities is a very important section, and the reason why they call this the self-propelling model and why it's so unique, in order to appreciate that, we must first understand a few fundamentals of how a lending business works. First of all, would you agree that a lending business is a very low margin business? In fact, spectacularly low margin business. And it's not very hard to understand, because आप सोचो 100 रुपए के लोन पे interest rates 12%, 15% at max, right? Well, not max, but let's say average 15% आप interest rate earn कर रहे हो as a lender. On top of that, half of that, at least 8-9% you're paying because you have borrowed the money, so you're left with 7-8%. Those 7-8% mein now you have to run your operations, the entire operations, that's roughly around 50%, 40%, right? So आपके पास 4% बता, उस 4% में you have to take care of the loans that go bad, right? So if your asset quality is not good, then obviously you have to deduct further from that 4-3%, and you're left with, let's say, 1-2%. Now banks, while their scale is larger, even the best banks earn 1.9% on assets, right? Spectacularly low margin business. Maybe some of the NBFCs, because the segment they are catering to is a little bit more, let's say, riskier, and therefore higher interest rates they can charge. Maybe some of the good NBFCs are earning, say, 2.5-3%. Some of them are even earning 4-5%, but that's very unique. So it is a very low margin business. Now, माई क्वेश्चन टू यू इज कि मान लीजिए आज मेरी ओवरऑल लोन बुक, टोटल जो लोन्स दिए हुए हैं, इज रफली अराउंड 7,000 करोड़, राइट, 7,000. नाउ इस 7,000 करोड़ को अगर मुझे 20% पे ग्रो करना है ऑन एन ईयरली बेसिस, विच इज समथिंग दैट इज अ रिस्पेक्टेबल नंबर, नॉट एन ईजी वन फॉर श्योर, तो मुझे रफली अराउंड 1,400 करोड़ रुपए चाहिए जस्ट टू फाइनेंस दैट ग्रोथ. सो वेयर कैन आई गेट दिस 1,400 रुपीज, राइट? If we look at mass financial numbers, and 7,000 is roughly where their loan book is at around right now, they earned on that 7,000 rupees, they earned 178 crores of profit, right? मेरे को चाहिए 1,400 करोड़ रुपए to grow 20%. I earned, मतलब खुद का पैसा मेरा, I've only been able to earn 180 crores, let's say, round it off. Right? Where do I get the rest of the money? Now, the second layer of where I can get the money is obviously it's a financial institution, so there is leverage. So, us 180 crore pay, I think I'll be able to borrow 4 times, right? 4.3 times is where the leverage is at for mass specifically. So then I have 180 ka 4 times is around 750, 780, whatever that precise number is, roughly around that. I'm still left with 700 crores or at least 600-700 crores more of money to be able to grow at 20%. And if I don't grow at 20%, if I only grow at, let's say, only 10%, I'm not going to get, the valuation or the respect or whatever in the market that I want as a promoter, as a person who's invested their whole lifetime. So growth is obviously a very important element, right? But I don't have the money, right? So what is that third source of money? Now, this is what most NBFCs and banks do. Now, there are there are 2 sources on this third level where you can get money. A, you can dilute your equity, right? Equity dilute karo, raise money from that. And again, I can dilute equity worth another 180 crores and I can get another 700 crores of leverage on it. So, mera roughly around, that's how I can grow. Now, in some cases, that 180 crores ka jo equity dilute kiya hai, maybe for some companies it's 2%, some for 5%, 10%, whatever, right? But the dilution will happen, right? And 95% of all NBFCs and banks have to dilute, right? But what Mass Financial has been able to do differently is, instead of diluting, it is doing something called direct assignment, right? And direct assignment is actually a very interesting concept, because the segment that Mass is lending to is micro entrepreneurs and SMEs. 85% of its loans are PSL compliant, right, which are priority sector loans. So banks have a target of around 40% that they have to give loans to the priority sector. Right? And what banks do a lot of times is they'll buy and sell portfolio of loans in order to meet those targets on a yearly basis, right? And because Mass Financial, most of its loans are PSL compliant, it has a reasonably good demand for its loan portfolios, which it can sell to other banks who are trying to meet their portfolios, because maybe they're not able to reach the same segment that Mass is able to reach or whatever, right? So they're basically buying and selling large chunks or large portfolios of loans, right? It's a big collection, a number of loans, whatever. So that is what's happening. Now, because that's possible for Mass, it is able to sell. And the way it works is that, and why that's so important and why it frees up money for growth is that, let's say I have a total loan book of 7,000 crores. Now, इस पे मैंने 1,000 crore worth of loans I am selling or I am willing to sell to another bank who is in need of it. So if I don't sell it, I will wait 3-4 years to get those cash flows, and that's how I earn money, right? But then I don't have free capital, right, to be able to grow internally. But if I sell it off, जो 3-4 साल में जितना भी मेरे को वैल्यू मिलना उन लोन्स का, उसका प्रेजेंट वैल्यू आई गेट टुडे, and all of a sudden I have, let's say, 1,000 crores of money that I can use to grow. And that's exactly what Mass has been doing. And if you look at this graph, it shows what percentage of the funding it was raising through direct assignment. And obviously in the past it was a lot higher, 40-50%. It has reduced to an extent, and going forward the management wants to keep it at 20-25%. Now question arises, why did it reduce, right? Very interesting. One of the reasons it reduced was that obviously during COVID, the whole outlook around asset quality obviously was कि जो दिख रहा है वो है नहीं, क्योंकि for a long time there was a moratorium, so banks could not actually declare NPA. So there was a level of uncertainty, and because of the uncertainty, the demand for these types of transactions, direct assignment transactions, it kind of decreased. Secondly, because obviously during the lockdown they weren't really growing, right? I mean, everyone was so focused on retaining and kind of like managing the risk and the uncertainty. I mean, growth was not really a focus. And because growth was not really a focus, you didn't really need that extra capital through direct. So a combination of all these factors, maybe more factors that, we are not aware of, the DA as a percentage of the overall funding mix has reduced, right? Going forward, it's expected to be 20-25%. Right? So that's one aspect of the liability section is so crucial. And because of this, promoter shareholding is 73%. And that means there is huge skin in the game for the promoter. So obviously as investors, I mean, I think as investors, we should be very happy if you are invested in the company, that of course you want to partner with a promoter who has a large chunk of their net worth into the company, right? So the whole skin in the game concept also applies. Now, another aspect is obviously we look at the cost of funds, because cost of funds is very important when you are borrowing money, right? And this is another part where the company has been kind of not criticized, but it is something that is not the liability side, which cost of funds hai, it's not considered to be optimal. Because if you look at it, in the last 5-6 years, the cost of funds has been, ekdam flat. And most NBFCs, most banks, you'll see they've actually, the trend is towards decreasing their cost of funds, but it has largely stayed flat. Now, there are a bunch of reasons for that. But one of the reasons is that the business model that Mass Financial has is borrows at 8-9%, and it's lending to self-employed individuals who are obviously a little bit higher risk, and therefore they're able to lend at say 15, 16, 17% even, right? So that is something that Mass has been criticized for. But if you look overall, as we will find out in the ROA section, between the borrowing and lending, I think it's been able to manage the risk extremely well, right? So with that said, let's actually move on to the next section, which is the asset side. We've talked about where we're getting the money from. Let's discuss how and where, to whom the company is lending money to, and how they're able to manage the risk. So as we know that for a lending business, the most fundamental aspect is the asset quality. And if you actually look at this diagram that we have created over reading thousands of, hundreds of con calls, reading hundreds of annual reports, analyzing pretty much 90-95% of the stocks within the lending industry, NBFCs, banks, small finance banks, all types of lending businesses, what we realized is that asset quality obviously is the most fundamental part. So asset quality, then you have to obviously make sure that you are creating a profit, and then you have to grow, right? So those are the three most fundamental elements for a great lending business. But now the question is that how do you judge asset quality, right? So in this case for Mass Financial, now we can look at three different aspects of asset quality, right? जो कि हम NPA ratios को देख के analyze करने वाले हैं. और तीन तरीके क्या हैं? One, we'll actually look at NPA ratios over over history, right? So over the last 8-10 years, whatever data we can consolidate, we'll look at that. Secondly, obviously that will help us to judge that over different stress events, because at different points in time you have different stress events, for example demonetization, COVID, all of that. We'll be able to see how the company has performed over these periods. Thirdly, we also want to compare it with other lending businesses that are similar. Now these businesses won't necessarily be exactly similar, because Some of them might be in different, be giving different kinds of loans and all that, but we'll try and compare that. So let's start off with the first one. Now in front of you, there's this graph and it tells us about the historical NPA ratios. And we can see that even on an absolute basis, initial part of the decade, listing se pehle to it was very, very impressive, right? Uska reason bhi hai, we'll understand that. But since then, we had demonetization in 2016, we had GST that came out, impacted businesses and the economy overall. That happened around 2017-18. Then we had the NBFC liquidity crisis, जो ILNFS का जो crisis था उसकी वजह से एकदम से पूरे system में, especially for NBFCs, the liquidity absolutely dropped. So you didn't have money, you couldn't lend. Then you had COVID, right? So in context of all these major 4-5 stress events in the last 5-6 years, still we can see that the NPA ratios are very, very respectable. And even the peak number जो कि March 2022 में reach किया था मास ने, that was around 2.28%, right? Now the question is, जैसे हमने बोल किया कि why 2017 से पहले क्यों लो था? So one of the reasons obviously is that there have been major crises in the last 5-6 years. But another reason is that the way to recognize NPAs, कि हम NPA classification जो norms हैं वो भी काफ़ी change हुए हैं. So in the past 180 days was when what was considered NPA, कि अगर 180 दिन के लिए the payment has not been paid by the customer जिन्होंने loan लिया है, that would be considered an NPA. Then that moved on to 120 days and now recently to 90 days. So naturally, if the criteria for NPA is lower, the number of days where you have to classify is lower, obviously the NPAs will tend to be higher. So going forward, I believe that I doubt NPAs will be around the 1% level, very tough, but definitely around 1.75-2% should be, is something that we are expecting. Now, the second thing we want to talk about NPAs, as we discussed, was, okay, we checked out history, we looked at the over different stress events. The third one is obviously compare it with other comparable companies. And in the graph in front of you, you should be able to see 4 graphs of NPA ratios. And while these firms are not necessarily comparable in the sense कि their loans are not in the same sector, जो कि हम अभी discuss करेंगे मास के लिए. So Spandana, CAG and Arman, they are mainly microfinance, right? So the risk here is even higher. They're group loans mostly that are unsecured. So even in that context, I think CAG, which is one of the best players in the microfinance sector, and even Arman, they've done phenomenally well. So in any context that you compare NPA ratios of Mass Financial, whether it is with these 3 predominantly microfinance type of lenders or with even big banks, I think a 2.2% NPA ratios in the worst of times is absolutely respectable. Now the question arises, what is driving this asset quality? And of course there is management qualities there, which has been displayed by the last 27 years that this company has been in existence and performing very, very respectfully well. Obviously the attitude towards risk, what happens when there is competition in the market, or when do they give up quality for growth, which is the most common reason for failure. At least in the case of Mass, that has not happened. And then of course, encompassing all of that, within all of that, there is, what type of loans are you giving? Where are you giving? What is your segment that you're giving to? So all of that is a very, very important element of, what drives NPA ratios. So to understand that better, let's look at the loan book composition. So आपके सामने 2017 में, if you look at the loan book composition, which is just when the NPA happened, not NPA, the IPO happened, we can see that 80% of loans have been given to micro-enterprises, right, which are small traders, and we'll look into more detail in just a second. Then you have your SME loans, right? Both of these make up 80-85%. Then you have around 10%, 9% two-wheelers, and the remaining other loans, right? Now, fast forward to 2022, over the last 5 years, it has not really changed that much, except for 2 major changes. सबसे पहले जो within the 80-85% of MEL and SME loans, the proportion of SME loans has increased much more, right? So that is the first major thing. And second, we can see this tiny percentage of personal loans have come in. They're around 150 crores. So very, very small. The company is experimenting with that segment right now. So that has been the change, right? But what are these MEL loans? What are these SME loans? The ticket sizes, kahan diya hai, kitne rate pe diya, all of that. Let's understand that now. So again, in front of you, we have this table which explains very beautifully the type of lending happening. So micro enterprise or micro, we can say entrepreneur also. These are very tiny entrepreneurs, right? Maybe kirana shops, very small traders and manufacturers. And yahan pe these loans are up to 3 years, 36 months, up to an amount of 3 lakhs. But if you look at the average loan, that's around 41,000, if I'm not wrong, right? So this is the kind of segment that the MEL loan has been given. These are, again, they are self-employed. This is a self-employed segment. If you look at SME, small, medium enterprises, the loans can go up to 5 crores. Right? The loans can go up to 5 years, up to 5 crores, but the average ticket size is only 26 lakhs. Right? So that's the kind of dynamic over here. This is now roughly around 30-35%. So a big chunk, the second biggest chunk after MEL loans. What are the types of loans that you can have within this umbrella of SME loans? You can have machinery loans, you can have working capital loans, you can have loans against properties, you can have industrial shed loans, you can have unsecured business loans. So all of these types of loans come under this category. One thing I noticed which was very interesting is कि अगर जून की presentation में देखें, so the average ticket size was around 15-16 lakhs, whereas here within a quarter it has jumped up to say 23-24 lakhs, if I'm not wrong. The number is 23 lakhs, right? 2.3 million. So one thing I noticed why that could be the reason is because as the economy is gaining confidence, right? And obviously, hopefully the worst is behind us. As things are moving forward, the credit growth is coming back in the system. Maybe the company is more comfortable with taking, I wouldn't say taking risk, but they are kind of gearing towards a more larger ticket. जिसकी वजह से the overall average has gone up from 30 quite meaningfully, actually 13 lakhs se 23 lakhs. So the new type of lending that's happening within the SME segment is much larger loans. Obviously this is also important for growth, right? Because the ticket size, if it's larger, you can grow in terms of that as well, जो कि हम काफी detail में समझेंगे in the growth part of this video. Right. Then we have the other segments that we have is we have two-wheeler loans, again around 9-10%. Average ticket size is 61,000 rupees. We have commercial vehicle loans. यहाँ पे used commercial vehicles हो गए, new commercial vehicles हो गए. These loans are a little bit longer, around again 60 months, so 5 years तक. And the average ticket size is around 3.87 lakhs, right? Then finally, the newest segment that we have, personal loans, which recently only the company has kind of started experiment in this segment, is around 133 crores overall in, over 7,000 crores, 133. So it's a very, very small proportion. And the management has said that they will work on this as they go along. The ticket size over here is also very small, 23,000 rupees, and these are loans up to 60 months. So hopefully this should give us a good picture of the types of loans that are being given, the segment that is being given, the average ticket sizes. So I think the company also in its disclosures, I think explains really well, what type of loans that they are giving. With that said, I think the next question, which is very, very important, is that how does it reach its customers? And as we discussed right at the beginning also, that MAS has a very, very unique strategy on the distribution front as well, right? In fact, most of these fintechs, one big part of why fintechs are gaining prominence is that they are able to reach customers mainly on on the digital side, and they're able to do it much more efficiently, right? So let's see how Mars deals with its distribution model, how it reaches its customers. Besides the obvious ways of reaching its customers, which is basically through a physical presence and now increasingly, more and more digital, Mars also follows a very, very unique distribution model. So we'll start off with the physical presence, understand what that is about, and then move on to this unique distribution model of Mars. So in terms of physical presence, 1 year ago, Mars had around, in September 2022, 21, it had around 100 branches. It was covering around 3,500 pin codes, and it was present in around 6 states and Delhi NCR. So fast forward 1 year, as things have begun to improve in the overall environment, as you know, like the banking and NBFC sector is kind of booming, or beginning to boom at least. So the growth part has really been focused on, and Mars has increased its branch presence from 100 last year to 147 now, covering nearly 6,200 pin codes, and now present in 7 states. So that's as far as the physical presence is concerned. And then we can see the 50% more increase in branches. I think that's kind of indicative of the prospects in the coming future, right? So that's that. In terms of the digital presence, I think that is something that is a little bit more tough, also because the customer segment that Mars is catering to might not necessarily need the digital per se as of now. And also in my research, I could not find a lot of data points or a lot of understanding on how Mars is working on its digital front. Incidentally, this is also one of the complaints that investors kind of have had with Mars particularly, is that their digital infrastructure is not as strong, and they've kind of lagged behind a little bit on that sense. But now they've started to digitize their processes and systems, and I'm sure they will find a solution to that problem. In fact, they've already started working on that. So that's for the digital. Now when you come to this unique thing that we have been mentioning again and again, so all of this started in 2002 when HDFC Bank actually partnered with Mars Financial, and what HDFC said was, hey, look, we'll give you the capital, we'll tell you the credit parameters, how to select what are the standards we want in our borrowers, and you go ahead and actually do the on ground kind of sourcing of the loan and kind of disbursement and all of that, right? Obviously, if there is a loss in this portfolio that you will build for us, right, HDFC saying to Mars Financial, you will bear the loss. Now this model is not very unique, and HDFC has worked with a few NBFCs on this model, most particularly AU Bank, if you've heard of that, very well known small finance bank, probably the best small finance bank in that segment, and they also worked on the same model. But so this model per se is not very unique, but what's very unique is that Mars took that model and actually started implementing it with other NBFCs. So in 2008, they started with one NBFC on the same model, right, where they would tell these smaller NBFCs that were operating in the areas that Mars wanted to operate in, but didn't necessarily have the presence or the understanding, the on-ground understanding. So in 2018, they started with one NBFC partner. When they were listed, there were around, I believe, 98 to 100 NBFC partners, and today there are 149 NBFC partners that Mars works with on this distribution model, right? So it is a very, very interesting take on how Mars, how it sources its loans. And even more interesting is that when it was listed 2017 May, that time the distribution, total loans that were given out of 100%, nearly 55% were coming through this NBFC channel, right, where other NBFCs were sourcing loans. And now what has happened is there has been a slight change in strategy because of multiple reasons, and the latest we are now seeing that 40-45% are loans have been sourced through the NBFC partners, right? And even more interesting about something about this model is that the NPAs, at least around till 2020, or quite for a long period, they were very close to 0%. And through this model, cumulatively over the entire last 12-14 years, Mass has sourced around 18,500 crores of loans, which have a total loss rate of only 0.5%, which is absolutely excellent by any standards that you judge. So there are a lot of pros to this model. However, there are also some cons, right? And the negative aspect of this is that first of all, already the management has decided to shift the strategy a little bit towards direct sourcing, meaning, through their own branches instead of NBFC. So they're saying that we're very confident on this model, but we want to grow, because growth is one of the limiting factors when you want to grow the NBFCs. You can't partner with 10 NBFCs every quarter, because it's very hard to find NBFCs that would have the kind of risk appetite, or the ability to control risk, and have the capabilities, and all of those things have to match. So the NBFC channel to grow is relatively harder, right? And that's why management is focusing more on growing its own physical presence and growing that way, right? So that's one con. The second con is that while it is a one-off situation, around October 2020, a fraud was exposed, and one of the NBFC partners that Mass had lent to was actually, involved in some sort of fraud, where they had inflated the book, the loan book that they were showing. So they were saying we have around 300-400 crores of loan book, and actually it was only around 150. So the rest of the figure was basically inflated, and they had diverted funds. So this NBFC, or microfinance institution we should say, is Sambandh Finserv. And when this case came forward, it kind of raised doubts as to the efficacy of this model. Naturally, as investors and as lenders, of course, you would raise eyebrows. But I think this is a one-off case, in my humble opinion. And, I think we can see that in the last 14 years, this is just one-off. And the company lost around 18 crores, which on the overall book, while was a minor amount, it did lose that money. But I think largely speaking, that had some implications on the NBFC model. That's my observation, my interpretation. Maybe I'm completely wrong, but given that happened, and then also a more shift towards direct retail presence and all of that, I think the company wants to kind of calibrate it a little bit going forward. So with that said, that's the asset side of the business model. Next, we want to discuss next we want to discuss the ROA tree and the profitability, and what are the triggers that can cause growth going forward. So the ROA tree is a simple tool to break down what are the drivers of ROA and eventually ROE. And these are the two most important efficiency ratios when it comes to analyzing banks and NBFC. So if we break down ROA, on your screen you can see there are two parts. Part 1 there are three key drivers of ROA: net interest margins, cost to income ratio, and NPA ratios, right, which determine ROA. And then in part 2, of course, how much leverage you have on top of that ROA, it will determine your ROE. So let's look at part 1. Now, if you look at net interest margins, and if you listen to the management's commentary and the con calls, right now they're at around 7%, and they're saying that we are going to be around that level. So there's not much of an incremental possibility as far as the net interest margins are concerned. They should be range bound, maybe maximum 7.25, maybe 7.5 at best. But I think the 7% mark is what we should expect, which is where they are already. Cost to income ratio, the second key driver of ROA. It is expected to be slightly elevated, at least for the foreseeable future, and uska sense banta hai because we just discussed how branches have increased from 100 last year in September 21 to now 147. So that expenditure has increased, and initially those branches are not going to give you a lot of business. They'll take some time to mature. So the cost of income ratio is expected to be elevated, but it should be kind of calibrated or adjusted, because the NPA ratios are also expected to be at least declined to some extent to around the 2% mark. So all in all, the management actually is very clearly saying that we don't really focus on one net interest margin or cost or whatever. Our idea is we want to keep everything, we'll adjust everything so that we can keep our ROA between return on assets between 2.75 to 3.25%. And if your question is that where are we at right now, right, we are at somewhere around 2.88% in the second quarter of FY23. And I think for the whole year, this should be, reasonably, I think very conservative estimate, this should be around 2.9, maybe 3% at best. So there's not much room for increasing the efficiency within the mass financials system that they are running right now. It's business, right? So where is the growth going to come from, right? The growth, unlike, if you remember IDFC Bank, we made a video, I'll link it somewhere here. There were significant drivers because there were cost savings coming in. There were significant drivers that were going to increase profitability for IDFC, for example. But in this case, I don't think there are any significant changes that will push up ROA, ROE from what they are right now, right? But so the growth is going to come from actually increasing the overall loan book, and that's what we're going to check out in the next section. So there are only three major sources of growth, not just for a bank or an NBFC, but any type of company. Number one is you increase the number of customers. Number two is you increase your average ticket price. In this case, average amount you're giving as a loan per customer. And number three is the frequency of purchase. मतलब कितना frequently customer वो product या फिर service purchase कर रहा है. In this case, whenever the loan runs out, whether the customer stays with the company or goes to some other NBFC or bank to take a loan, right? So these are the three major sources of growth. Now we can break down each one into further subparts. Just say number of customers, what are the factors that are working for mass? So सबसे पहले है branches, physical presence. We already discussed how branches have increased from 100 to 147. Number of postcodes covered increased from 3,500 to 6,200 postcodes within 1 year. So the branches part, we can see there is growth happening over there, and that also aligns with the strategy or going forward that the management has said कि हम अब direct distribution पे थोड़ा सा ज़्यादा focus करेंगे versus NBFC distribution, which is the second source of growth, right, for the number of customers. Obviously, that source of growth is somewhat limited, and you can't keep adding NBFC partners at the same rate as you can add branches, right? Number three is obviously a relationship with fintechs. So fintechs recently, I think over 1.5 year period, only Mass has started working with fintechs, and the loans that have been giving, or the number of customers acquired through fintechs is, makes up around 8% of the overall loan book, right? So those are the three key ones. Then there's another fourth one, which more and more banks and NBFCs are using, which is digital acquisition. Now on this front, as a retail investor, reading all the publicly available material, there is not a lot of data या फिर indication कि digital sourcing कितना strong या कितना weak है. My guess is it is not very strong at all. And that's something either by choice, by design, they have decided not to focus on digital sourcing. Maybe their customer segment is not, very prone to being acquired in that way. I'm not really sure about the strategy happening, but more and more banks, and NBFCs and everywhere is adopting this digital acquisition. Maybe partnering with fintechs in and of itself is Mass's way, the company's way of, acquiring customers digitally. We don't know that for sure, but these are the four key sources through which number of customers can be increased. The second source of growth is obviously you increase the ticket price, right, or how much loan you're giving to on average to an individual customer. To give you a context, two major sources, जो micro-enterprise loans or SME loans, which form 85%, the average ticket price back in 2017 when it listed for micro-enterprise was around 23,000 rupees on average for MEL loans. Today, it is around 47,000, on average. So growth in the overall loan book has happened in that direction. And if you look at the SME loans, at the time of listing, the average ticket loan or ticket size of the loans per customer was around 10 lakh rupees. Today it is 23 lakh rupees. So, so the increase has happened a lot higher with SME loans. Also, because these are self-employed kind of micro entrepreneurs and, entrepreneurs, so by the very nature of this lending, as the size of these businesses grows, they will require more money. So if, for example, my business is growing, I will require more working capital. I will require more money for, or larger amounts of money. So this growing through growing the average ticket size or average ticket, the loan that you're giving, that is kind of inherently inbuilt into the model for Mass Financial. Right. The third source of growth is obviously how frequently you are giving loans or how many loans you can give to a customer. Now, this is something that you would not necessarily want the company to exploit too much, because आप एक customer को अच्छे से serve करो and obviously try to keep them over a lifetime, but you should never want to, or you would never want to, give them 2-3 types or stuff them with, money. That's not necessarily the direction you want to go in. So I think these are some of the sources of growth that can happen for the company. Just to add one last point to the growth part of the analysis. So growth has happened actually much faster in the last 1 year. So quarter on quarter, if you see, the growth has been 30%, which has actually kind of led to a lot of re-rating in the stock. But going forward, at least according to the management, the guidance they are giving is around 20-25% of growth, which, by the way, is a great number if they can keep up with it, over 3, 5, 7, 10 years, right? Now, what are the factors that can, that can stop the company from growing at that rate, right? What are the risks involved? Let's discuss in the next section. The first major source of risk for Mass Financial is obviously from competition. But competition is an interesting, dynamic, especially in the lending segment, because especially for SME lending and micro enterprise lending, the segment that Mass is operating in, because the size of the opportunity is so big, it might be shielded from competition, at least for some time, right? We'll only see how it plays out, a couple of years down the line. And especially with fintechs coming in, being more efficient, being able to source loans much more efficiently through the online channel, we'll see how the cumulative impact of competition in this segment will play out, right? The second key risk is obviously lagging behind on the technology front, and this is something that Mass Financial is actually guilty of, and investors have kind of given the management feedback as well, and they are working on digitizing their processes and actually making things much more streamlined on the technology front. On that front, as we discussed, they've started working with fintechs as well. So they are working on it, and we'll see how it plays out. The third risk and major risk is the key man risk. So with banks and NBFCs lending businesses, because culture and attitude towards risk is such a huge part, and as we already know, one of the co-founders unfortunately died during COVID, and the remaining founder, if something were to happen for whatever reason, I think that is a huge risk for this company. The fourth key risk is obviously slower than expected growth, because currently management is guiding for 20-25% growth. For n number of reasons, if they're not able to get that growth, then at least if I were to comment on the valuation front, the prices currently do not seem to be justified if those growth numbers are not hit for 20-25%. So to justify the current valuations, I think those numbers must come true. And if anything happens so that the growth doesn't come through, chances are that investors at this current point, at this price point, may not be able to make money on the investment. So with that said, and obviously the last risk is the unknown unknowns. We just don't know what we don't know. And so yeah, that's also another risk. So hopefully this video has been insightful. This business analysis has been insightful for you. If you liked it, please consider subscribing. And thank you. See you in the next video.